Hello everyone. If you are new to the channel, welcome. Otherwise, welcome back. In this video we are going to cover another aspect of the financial world. The bank rate, also known in the UK as the base rate. I will try and go over various aspects relating to this topic. It will not be a complete guide, but by the end of the video you hopefully will have a more rounded idea of what it is and how it operates. So let's get into it. In the United Kingdom, the official bank rate, also known as the base rate or interest rate, is set as part of the monetary policy of the UK. The UK's central bank, the Bank of England, is responsible for setting this rate. The rate is what the Bank of England charges other banks and other lenders to borrow money from it, and also interest it pays on deposits. Within the bank, there is a group of 9 individuals who make up what is called the Monetary Policy Committee. They convene 8 times a year to review the rate, and it is this committee who agree if the rate should be changed. The committee comprises of the governor of the bank, 3 deputy governors, the bank's chief economist, and 4 external members appointed by the Chancellor of the Exchequer. They each have 1 vote of equal weight, to which the governor will vote last to act as a casting vote in the event of a tie. During these meetings, on the first day, the committee will discuss the UK economy along with the world economy. On the second day, the agenda will consist of main policy discussions, where members debate on the correct course of action. On the third day, a vote will be taken as to if the rate should change. At noon the following day, the result will be announced. So now we have talked about what the rate is and how it is decided. Let's take a look at why it's important to members of the UK public. One of the main uses of the base rate is to try and control the rate of inflation. Inflation is the general increase in price of goods and services within the economy. Controlling this allows for real demand for goods and services, whereas high inflation encourages negative effects. These include such effects such as shortage of goods, hoarding, unemployment, and the general population's inability to live in a way that constitutes basic living requirements. This will mean paying for electricity, gas, and food will be more expensive, as wages will not rise as quickly to compensate. Governments tend to agree that a rate of around 2% inflation is acceptable. This is somewhat arbitrary, but is agreed for inflation targeting and price stability across the world, originally originating from New Zealand's central bank. The base rate controls inflation in several ways. When inflation is high, the interest rates is generally increased to combat it. By increasing the base rate, retail banks can earn interest at this rate should they deposit their money with the central bank over lending it out via loans or mortgages. If these banks do loan out any money, it will generally be the base rate plus a small amount on top to make it worth their while in doing so. This can be seen clearly with mortgages, where they are provided with a variable rate which will follow the rate the central bank sets, so that the retail bank always earns more from the mortgage over a deposit. With the central bank, a rise in the base rate will mean an immediate increase in the mortgage repayments. This means less money to spend on other things for that individual. Less money to spend means fewer goods brought, which means businesses will be less likely to raise prices of those goods. This should reduce inflation. Individuals with fixed-rate mortgages will have no immediate effects from a rate increase, but they may have a higher rate several years in the future when they renew their mortgage deal. However, new mortgages will cost more, even if they are fixed or variable. This will reduce the number of new buyers on the market by pricing them out of buying a home. This will have the effect of stalling or reducing house prices. Existing mortgage holders on a fixed rate will then feel poorer as their house is no longer worth what it previously was, and thus might also spend less. Again, reducing inflation. Companies are also not immune to a rate increase, as it will mean taking out a loan for growth will now cost more. It may mean fewer jobs are created and thus less money for households, which again means less spending and less economic activity, reducing inflation. Maintaining this balance is essential, as a higher rate could tip the scales too far and cause a recession and stalling the economy. This can have the same effects as high inflation. That is all for this video. Please rewatch if anything is unclear. Comment if you want more information and I will make further videos. If you want more information on why I'm making these videos, please our mission statement in the details below. As always, look after yourself and your money, and I will see you in the next video.